Um, so, you've finished the last homework assignment, and then all you've got left is the project, which is due a week from today. And so far I've only had, I think, one person check their answers with me on the project. But if you want to make sure that you're on track, I'm happy to tell you for scenarios 1 through 4 what my numbers are compared to yours. And of course, the fifth scenario, where you are personalizing it to yourself, what I'm hoping you do with that is you make the expenses more realistic, because I just threw these expenses together for the different hypothetical people that you're analyzing in 2 or 3 minutes. And if you think a little bit more deeply about how you actually spend money and how that may change over time, then I think that could make this analysis a lot more useful. Like where you are probably spending less now than you will in the future if you choose to have children, or you're spending less now compared to the future when you buy a home or start driving a Lexus, or whatever the case may be. You're probably going to be spending more in the future than you are now. So I'm hoping that the expenses are more accurately reflective of your plans, and that the constraint is that you have to, through a combination of retiring early and maybe changing your income, working less during your working years, and then also giving money away. Through some combination of those 3 things, the constraint is, for purposes of analysis on scenario 5, is make it so that you get to age 85 with no money. So that's the project. Any questions before we move on from the discussion of the project to depreciation?
What kind of assumptions should we make about our income for like the next year or two? Should we assume that we're going to make like a certain amount of money?
You mean before you graduate?
Yeah.
I don't know. I think individual circumstances may vary. I think some people in graduate school have university tuition remission, but they're still maybe living on loans. Some people have their employer picking up the tab. So I don't want to dictate to you what you should assume. I think, since you're in school now, you probably could just extrapolate your current semester's expenses another year into the future, and that would be good enough. But I don't have strong opinions on it has to be a certain way. I want this, analysis 5 to really be reflecting your assumptions.
That makes sense. And then if we're graduating with debt, we would just start off with a negative savings,
that's right,
$10,000 or whatever it is.
Exactly.
Gotcha.
Yep. Anything else? I can't resist. I have to show you one thing from my spreadsheet. I'm too proud of it. It was too fun. I enjoyed it so much, this project. So the thing I want to show you is, the one where you're trying to figure out how early you can retire?
Yeah.
So whose is this? Let's see. Sean, this is yours. Okay. So I think that's scenario 3, where you retire early. So what I've done for the income is I'm having it refer to one of the previous analyses, where you've got a certain income amount and it's increasing according to the pattern that's defined. And that's, if you look, it's going to column P. But then down here at the bottom, where the person is retired, it's looking at column F, which is over here, it's kind of like the retirement income amount. And so what I did for this third analysis is I'm starting off, okay, what if the person retires at age 85? Look at the retirement income instead of looking at the, okay, let me just extrapolate this down all the way, but not to the very bottom. So if the person works until, no, it didn't quite do it right. Let's see.
I'm just going to give some insight, because on mine I had to individually change each.
No, it can be way, way easier than that. Okay, so it's looking at the income. this is where, okay, so Sean I have retiring between age 42 and 43. So let me just, this is if they work all the way till age 84. So look, this person would have $4.1 million if they work till age 84, and 85 is retired. So, you know, it's switching from column P, which is the work income, to column F, which is the retirement income. But if I drag this up, what I'm basically doing, this is their retirement income, and all of it above it is the work income. But if I drag it up, it's like I'm saying switch to retirement earlier.
Oh, that's cool.
And so then I just look, what is the effect down here at their savings balance? So what if I take it from retire at 85, I'll say retire at 70. This is still somehow weird, because what is this, why it's going from 138,000 down to 60-something thousand? I had to remind myself.
They retire at 67 in scenario.
Oh, yeah, okay, so that's what it is. I need to have it look at the income where they never retire. So that would be column H. Okay. So scenario 3, income, I should make it, instead of P, I'm going to make it H, because that's the one where they just keep working forever. Okay, let me take that down through age 84. Okay, 6 million is how much you'd have if you keep working until the very end. And then this is going to be the retirement income, which I had, that's column F. Okay. So you can see it's a lot of money, and then they skip down to the retirement income in age 85. They've got 6 million, so that's too much. So if I just drag it up, I'm saying, okay, they'll retire at 75. Now they've got 5 million when they retire. Drag it up, what if they retire at 65? So it's actually a pretty easy analysis if you have it set up right. It's just looking over at the retirement income instead of the work income. And we're getting closer now, because now he's got at 1.1 million, and here at the top I think I've got, I could have like the max. So I could see what is the maximum amount. No, I don't want the max. I just want the last one. So the ending balance. So I want to be able to keep an eye on the ending balance as I continue to drag this up. So where are we at so far? Did I somehow change it again? Oh, no, okay, it's in age 46 is working, 47 is retired. So if I just keep going up another year, 944,000, I need to get him to retire early because he's still working too long. I'm getting closer. He's almost to dying with 0. And if I go any further than this, I think I'm going to go negative. So if he retires at 42, then that means negative balance, but working until 43 is okay. I'm sorry, working 42, retire 43 is okay. So that's the trick I wanted to show you, is that if you just kind of gradually work from the bottom up, then it may save you a little bit of extra time as you're doing that analysis number 3. That's all. All right, now let's talk about depreciation. Depreciation is when equipment loses value. And you've probably heard before that if you buy a new car and drive it off of the lot from the dealership, suddenly it's worth less than it was before. Nowadays, cars are so well built and there's such a big demand for used vehicles at our current moment in time that the depreciation isn't as bad as it used to be. I remember maybe 10 years ago, people would suggest that just driving it off the lot, maybe you lost 10% of the value of the vehicle. But regardless of whether there's that immediate initial drop, I think what all of us recognize is that a Honda Civic from the early 1980s isn't worth as much as a Honda Civic from the mid-2010s. And depreciation is a real thing that is related to the reduced usefulness of equipment. But there's also a parallel fictional thing called tax depreciation that is more of a theoretical concept that doesn't necessarily have to be linked to the reduced usefulness of the equipment. So the equipment might be as useful as it was when it was first owned, but you still have depreciation, which is a reduction in the taxable value of the equipment, that is important for you to keep track of because it can be deducted against your income and it reduces how much you have to pay to the government. So the government allows you, when you're operating a business, when you purchase equipment, the government allows you to deduct the cost of that equipment from your profits. But they don't allow you to deduct it all in the year that you purchase the equipment. So if you're putting together a factory and you need to have some really expensive machinery, you know, that machinery is going to reduce your profits, and so the government allows you to reduce how much tax you pay based on the value of the equipment. But instead of having 1 year where you basically have no tax because of the cost of that equipment, they allow you to depreciate the equipment, so spread it out over several years under the notion that the equipment is somehow becoming less valuable. So that's what tax depreciation is. It's more of a financial calculus. And when we keep track of the reduction in value of equipment, it's important for us to identify the basis, which is the initial purchase price plus the installation costs for equipment. And the cost basis you can think of as it's kind of like the initial book value. And then the book value over time is just how much the equipment is worth according to your accounting statement. So it's not necessarily how much you could get for the equipment if you tried to sell it, but it's simply the book value is the cost basis minus all of the cumulative depreciation that's occurred over time. So depreciation is just this calculation of a certain amount of the equipment's value is reduced each year, and the book value takes all of that cumulative depreciation into account. What we're going to talk about today is several different methods that are used in order to estimate depreciation. So the simplest approach is just that every year a certain amount of money is reduced from the value of the equipment. And that is called straight line depreciation because if you were to graph the starting value and the salvage value of the equipment, then it would form a straight line. So for instance, if we have on the vertical axis book value and on the horizontal axis is time, when you first buy the equipment, it has the cost basis, B. And then according to straight line straight line depreciation, it could every year be decreasing over time. So 1, 2, 3, 4. Let's say that this equipment goes down to a salvage value of 0 after 5 years. So the slope of this line suggests how much money is lost each year in terms of a reduction of the book value of the equipment. So the book value starts at the cost basis, which is the purchase price plus installation and setup costs. And we just say every year there's just a certain amount of depreciation. So this would be the depreciation for 1 year, the reduction of value that occurs. So you can have a salvage value that goes to 0, or you could have a model where, you know, the equipment is going to have some disposal value at the end of its useful life. So maybe at the end of its useful life, instead of just throwing it in the dumpster, maybe you're selling it for scrap, and it has some salvage value that's positive at the end of its useful life. you'd still have a straight line connecting the two in this straight line model. Now, declining balance says that instead of having a fixed number of dollars that always is reduced every year, instead of having it be like $1,000 off every year, something like that, you'd have a certain percentage reduction in the value over time. And so if it's always going to be the same percent reduction, instead of being a straight line, what you'd have is you'd have a curve that kind of follows this trend, where you have more reduction up front, and then it gradually starts to taper off, where more of the value is lost early, and then the reduction in value decreases over time. And in a declining balance, you have a salvage value as well. The final system we're going to talk about, MACRS, the Modified Accelerated Cost Recovery System, it starts off as curved, but then it switches over to straight line. So it assumes that the equipment is going to go down to zero value at the end. And companies like this method because, remember, they want to have as much depreciation as possible as early as possible, because any depreciation that they can show counts as a deduction from their taxes. So if they have lots of depreciation, then that is going to reduce the accounting of their profits, and therefore if their profits appear to be lower, then they don't have to pay as much tax. And so the incentive for companies is to have a big depreciation and early as possible in order to maximize the value of those tax benefits. So let's start by talking about straight line depreciation, and it's relatively simple. The main factors that you need to know here is the initial starting value of the equipment, the book value to begin, the first basis, the salvage value at the end of the useful life, and then the number of periods that you're spreading it out over. And so you can know the book value at any year by simply starting with the initial cost basis and subtracting out the cumulative depreciation up to that point. But it's the number of years multiplied by the depreciation for each year. So in straight line depreciation, every year it's the same amount of dollars that's being reduced. So just as an illustration, let's say that we had some equipment that's used for processing argon gas, and we pay $20,000 to begin with, and it will have $5,000 of salvage value at the end of 5 years. So what that means, if you look at the figure, the graph, we start at 20,000 as B, S is 5,000, so it's going to have a reduction of value of $15,000 in 5 years. So every year there's $3,000 of depreciation. So that's the depreciation in the first year, in the second year, and the third year. It's always $3,000 every year. So D sub 3 here, which it asks for in part A, is $3,000. And so then the book value in the third year would be the initial purchase price of $20,000 minus 3 years of $3,000 per year. So that means that you've got $11,000 worth of book value at the end of the 3 years. So straight line depreciation is pretty simplistic. Let's take a look at the first in-class exercise that we've got related to this for straight line depreciation. Let me give you this handout. It's just the first page of the handout is what we're going to work on, where we've got several different pieces of equipment. And we're going to calculate for a loader, a mixer, and a crusher how the depreciation changes over time for these 3 items together. So you can see in part A, what we want to know is the total depreciation in each year. So that means find each item's individual depreciation and then add it all up. So that's the first part for part A, and I'll leave you to read through the rest of these, but for each one of these, like in the case of the loader, you're starting at 48,600, you're ending at 11,200, and it occurs over 7 years. So you can calculate D sub T for the loader, and it'll be a different D sub T for the mixer, because the starting cost, the ending cost, and the number of periods is different for each one of these different pieces of equipment. Let me bring up the solution to the first couple of questions up on the screen here, just to make sure that we're all headed on the right track. So we have to treat the three pieces of equipment individually, and the loader, for each of its 7 years, is going to have a reduction in value of 53, 42, and 86 cents. Whereas the mixer goes from 25,900 down to 0, and it does that in 4 years. So each year it's 64.75 in depreciation. So in the first year, all three of the pieces of equipment are contributing to the total depreciation, and so the total depreciation is the sum of the individual parts. And now for part B, it's just asking for the book value at the end of year 3. So what we have to do for that is we have to find out the starting value and then 3 years of depreciation for each of the pieces of equipment, and then find out what's the residual book value for each individual equipment, and then add it all up for the total book value. Okay. So question C, the book value of all the equipment at the end of year 5. So this question C is just to illustrate that once the mixer goes to 0, it's no longer contributing to book value. That equipment has been exhausted, and the remaining items that have book value is just the loader and the crusher. And so then the total book value of the equipment at the end of year 5, 84,107 and 90 cents. And then the last part here, question D, is saying how much depreciation in year 8. So in year 8, the loader is out, the mixer is out, so all that's left is the crusher. And it has the same $9,955 of depreciation every year, including the 8th year. So the depreciation in year 8 is $99.55. So that's straight line depreciation. Now, declining balance depreciation is more complicated than straight line. Instead of having every year the same amount reduced, it is a percentage or a fraction that is being reduced each year. And in declining balance depreciation, because it's always a certain percentage that's being reduced, it can't go below a salvage value. It can't go to 0 in declining balance. And the maximum rate for declining balance would be twice the slope of a straight line depreciation. So here's the formula for how you calculate the depreciation amount in a given year. It's the book value from the previous year. So if T is the year that you're in, T minus 1 is saying, what's the book value last year? And then this value D is the fraction that is of the previous year's book value that you're reducing to calculate this year's depreciation. And the lowercase d can be defined either by a certain percentage, like the problem statement would say you've got 200% declining balance depreciation, or 150% declining balance. And that just is trying to tell you how steep is the slope of the line originally. Or it can be defined by knowing what is the salvage value you're aiming to achieve at the end of the year of the item's useful life. So the D can be defined either way according to those techniques. And so then you could find the book value for this year by just looking at last year's book value and subtract out this year's depreciation. Or this formula will tell you the cumulative depreciation that's occurred through several years.
Is there a difference between big D and little d? And
Yes.
What is that difference? You may have already explained it.
Big D means the depreciation in dollars that's going to occur in a given year. The little d is a fraction. So it's going to be like 0.15 or 0.2. And so what it means is it's the percentage of the previous year's book value that is being lost during this year.
Gotcha.
So D is unitless. Lowercase d, it doesn't have units. Big D has units of dollars. So I think it'll probably be maybe a little bit more clear when we work through this example. I'll just illustrate this and then you'll get some practice on the in-class exercise. So let's say, for instance, that we had a truck that has a first cost of $80,000. And this is different from the handout that you've got for the in-class exercise. So this is just as an illustration. If we started off with $80,000 and we know it's going to last for 10 years, then just to illustrate both of the methods, because this is saying you can either do it by a percentage or you can do it by a salvage value. Let me first show you the percentage way. Sometimes they could say 150% depreciation. And what that means is that the first year should be steeper than the straight line depreciation would be. So it's like 50% more depreciation in the first year than there would be if you were assuming straight line depreciation. Okay, so what we could do is set this up on Excel just to illustrate how you do it. Let me start up a fresh workbook in Excel.
So will we do this by hand or in Excel?
I think Excel is the way to go for the declining balance. Yeah. All right, let me just paste over the formulas so that we've got them to see as we're working into Excel for this illustration. So there's the formulas, and the problem statement on this one is that okay, $80,000 is the first cost, lifespan of 10 years, 150%. Okay, so I'm going to say our first cost is the basis. So the basis is $80,000. And N, the number of years, did it say it's 10 years? And we have a column where we're going to do the year book value and the depreciation. Okay, so at time 0, the book value is just the starting cost basis. And let's calculate for 150%. We're going to use this formula to calculate the lowercase d. So let me make some more room here. So the percentage that we're going to have is 150, and so then that's going to make lowercase d equal to 150 divided by 100 times n. So that makes my d factor 0.15. So now what that's going to allow me to do is know the depreciation for any given year is the book value in the previous year multiplied by that factor. So like, for example, in the first year, the depreciation amount is going to be equals to D multiplied by the book value in the previous year. So $12,000 is going to be the depreciation because that's 15% of last year's book value. So then that makes this year's book value, like after the depreciation occurs, it is the previous year's book value minus this year's depreciation. Okay, in the second year, we could first calculate the depreciation that applies this year. So it is the D, and I guess I can anchor this reference and then I'll drag it down in subsequent years. So 15% of last year's book value tells me that this year there's going to be 10,200 of depreciation. So this year's book value is last year's book value minus this year's depreciation. And I can do through 3, 4, 5. This goes through 10 years in total. That was the given N for this problem. I think I can probably just drag this all the way down. And what we get to is it's going to have a final salvage value of $15,750. And let's just check the formula to make sure that it did what we expected all the way through. So each year's depreciation is 15% of the previous year's book value. And this year's book value is last year's book value minus this year's depreciation. So we've got now a timeline of through the years how the book value is declining and what is the depreciation that applies to each one of those years. Okay, so any questions about that approach? That is if we use the percent method. There's also this method where we say we know the salvage value we want to hit at the end of the time. So let's do another one where we've got, let me just start over again. Okay, so we've got our initial cost basis of 80,000. We've got 10 years once again. That's odd. Okay, so we're going to do, again, year, book value, and depreciation. We're going to go 0 through 10. But this time we're going to say that there's a certain salvage value we want to achieve. And I think in the problem statement for this example it says, let's go with the salvage value of $10,000. Okay, so if we want it to hit $10,000 in the end, then the starting book value is the same. It's 80,000. Okay, now in the first year, the depreciation is going to be, according to this factor D. We need to calculate D a different way. So this time D is equals 1 minus S divided by B to the power of 1 divided by n, and n is 10 in this case. So 1 minus s divided by b to the power of 1 divided by n. So basically to the power of 0.1 is what it's going to do. Okay, so what that tells us is that every year the book value needs to decrease by 18.77%. And it's got to be like exact, because we want it to be exactly to the penny, $10,000 at the end of the 10 years of depreciation. So this is the percent reduction that's required each year to hit that book value of $10,000 by the end. So let's apply it and just to see. So the depreciation at the end of the first year is the previous year's book value multiplied by this factor D. And I'll anchor the reference there by pressing the F4 button. Okay, so then this year's book value is last year's book value minus the depreciation that happens this year. And then I can drag this down through the entire set of rows, and what you'll see is in the end it gets us to that exact $10,000 book value that we need, and every year the depreciation is getting down lower and lower. And the notion here is that equipment does lose its value more at the beginning than it does at the end. And so this maybe follows reality more closely, but the reason why companies don't like this declining balance method is that they want equipment to depreciate to zero value. And this declining balance method, you can never actually go all the way to zero with it. And so it leaves some money on the table, and they're not able to get all of the full deductions that they might otherwise want to try to achieve. So any questions about this method with Excel? So I'd like you to get some practice with that. The next part of the in-class exercise ask you to get some practice with this same technique where we have roadway paving machine that has a first cost of $486,000. It's going to last for 8 years. And so determine the depreciation in the book value according to the 150% declining balance approach, or if there's an estimated salvage value of $87,000. So what you can do for this one is, if you already had the spreadsheet set up from the example, is just create a copy of it. So if you do right click, move or copy, and then create a copy, then you can adjust this one. So this would be like the in-class exercise problem where the other one was the example. And you can adjust the in-class exercise, or you can just do it from scratch for the practice. But we want to find out for this one, how does it look for the depreciation and the book value row by row, year by year, through each of the 8 years. Okay. So now you are the master of both straight line depreciation and declining balance depreciation, but can you explain why businesses want depreciation? Because depreciation is basically saying that their equipment is losing value. So why does a company want their equipment to lose value? Ben?
To claim your assets on your taxes.
Yeah.
And if your assets are worth less, then you pay less. It's the same reason that a lot of companies, when they're, especially the bigger they get, they start to buy company vehicles.
Mm-hmm.
And or they'll buy new equipment at the end of the year, because if they made a certain amount of money that year and they have to pay taxes on that, they can buy fleet vehicles or personal vehicles and say they're company vehicles or equipment for the company and say, oh, I took this loss as a business expense, but it's really not.
Okay. Yeah, that's a good point. Yeah, it's not that they actually want their equipment to wear out. I mean, they'll try and preserve the quality of and usefulness of the equipment as long as possible. It's just the book value. And this is really important. The emphasis is on like the accounting aspect of it. You want the equipment to lose its value early because dollars now are more valuable than dollars in the future. So you want to have an accelerated reduction in your equipment's value as early as possible and as big as possible, because it means you'll have to pay less tax. So I want to just reinforce that concept before we move on to talk about the last technique for estimating depreciation. Modified accelerated cost recovery system. This is the most modern and widely applied method of depreciation, and part of the reason why it's become so popular is because it allows equipment to be depreciated down to zero, which is good for them, but then also the calculations are easier. You don't have to use a formula. You just look up an item's class, and there's a table that tells you what fraction of depreciation occurs during each year of its class life. So the characteristics of this modified accelerated cost recovery system is depreciation to zero, and it switches from double declining balance to straight line. And that's how it gets to a salvage value of zero. Is remember, double declining balance can never go to zero because it keeps just tapering off and flattening out. And so it switches over to straight line depreciation halfway through. And I'll show you that in a table where it makes the switch. And the way it works is every piece of equipment is put into a category, and then just by decree, all equipment in that category depreciates for a certain number of years. And so there isn't any arguing back and forth about how long the equipment should have for its useful life period. It's just sort of by categories, and we'll look at what those categories are. And sometimes they line up with the actual useful life of the equipment, and in other cases it's probably just an arbitrary number of years rather than a realistic estimation. Now, the one less complication of this system is that it knows that people are going to try and play games. Like Ben was saying, a company might buy a truck at the end of the year, to try and quickly, before they have to pay taxes, make it look like they had a big expense. Because they know that people are going to do that, regardless of when you buy it, whether you buy it at the beginning of the year or at the end of the year, you can only take half a share of depreciation in the first year of ownership. So we'll see that in the table in just a moment, but the half-year convention assumes that you're buying the equipment halfway through the year, so you only get to charge the depreciation a half share of it in the first year, and then that same fraction carries through to the last year as well. So let me show you these different categories first of all. So for example, it's assumed that we're going to use the GDS recovery period. So it's estimated that buses may have an actual physical useful life of 9 years. I think that's what's meant here by the class life, is in reality a bus might last for 9 years. But in the GDS system, you're going to take all the depreciation in 5 years. So that's good. Companies like that. They want to have the depreciation over as few years as possible because that brings more of it closer to the present, instead of pushing the depreciation out into the future where money isn't worth as much. Petroleum refining equipment maybe lasts for 16 years, like the pumps that can bring oil from the ground, where its recovery period is 10 years. So all these different types of equipment have a certain asset class category, and based on what its asset class category is, that's how you can calculate the recovery period. Now, once you have a certain number of years for the recovery period, let's say you're doing something that's related to equipment for the manufacture of carpets. So maybe like a textile mill, carpet making equipment, 5-year recovery period. You'd find the 5-year column, and then just the fraction is already calculated for you. So this is similar to that lowercase d, where it's telling you, actually in an even simpler way, if you know the starting basis, then the book value, the depreciation for each year is this percentage multiplied by the starting basis b. So the first year, remember, is just a half share of depreciation. The last year is also a half share. So you'll notice that at first, let's look at the 10-year life. At first, we have 10% of the depreciation in the first year, then 18, 14.4, 11.5. It's declining, and then it switches over to straight line. So it's going from double declining balance to straight line. And so for several years, the depreciation is the same. See, 0.655, 0.0655, 0.0655, basically, 0.0655. So it's straight line, straight line, straight line, straight line, and then the last year is half a share of straight line. So, it's even easier to see on the 20-year depreciation table that you've got the same fraction for part of the time, but then for part of the time, it's a more accelerated depreciation where more of the value is front-loaded. So to get some practice with that, what we do is you take the depreciation amount is the factor D for that year multiplied by the initial first basis, and then the book value in any year is just the cumulative depreciation that's occurred being subtracted from the initial cost basis. So the last example in the in-class exercise for you today on the third page of that handout is saying, what if you buy a bus that's $238,000? And I guess I need to update the text of this because this is back in 2018. But let's say we're buying it now. So you're buying the bus. So first of all, what category should it be in? Well, we see it's in asset class 00.23. So here's our buses. And we're going to do GDS method. So that's a 5-year recovery period. So now you go to the 5-year recovery period, and the ironic thing, even though it's a 5-year recovery period, there are 6 rows. So remember, the reason why there's 6 rows is that you only get a half share of depreciation in the first year and a half share of depreciation in the last year. So what I'd like you to do is calculate the depreciation and the book value for every year. So you're starting off with $238,000. So at time 0, so we're going to have time, depreciation, and then book value. So years 0, 1, 2, 3, 4, 5, and 6. Starting off with the book value at $238,000. You can calculate the depreciation by multiplying this percentage, so 0.2 times the initial book value, so 0.20 times 238,000. So that will be some amount, and the book value at the end of the first year is 238,000 minus 2% of 20% of 238,000. So what is 20% of 238,000? 238.2 times, okay, so it's 47,600. So 238,000 minus 47,600, that's 190,400. So do that for all of the years using the table of data that's provided. Up on the screen, I've calculated it, of course, the easy way, because that's maybe easier to illustrate on the screen this way. So we start off with the given book value of $238,000. Anytime you use MACRS, it should depreciate down to 0, so you can check to know if you've done it right. But if you add up all of the factors, like if I sum all of these factors, you'll notice that the sum adds up to 1, which means 100% of the value has been depreciated, bringing the book value down to 0 at the end of the 6 years.
Dr. Wade?
Mm-hmm.
This might sound like a really stupid question, and if it is, that's okay. But 27,000 of 41,000, that's almost 50%. So 0.1, how's that correct?
You said 27,000.
So like in your 4 there, so
Year 4?
yeah, your book value is 41,000 and you're depreciating 27,000, but your depreciation factor is only 11%.
But it's 11% of the book value. It's not 11% of the previous year's value.
Oh, that's what I.
That's where I'm messing up.
So it's always, the depreciation amount is always, yeah, let's check the formula. That's not a stupid question at all. The depreciation is just B. It's not the previous year's book value. It's the starting cost basis.
Oh, it's the starting of the whole.
Yeah, so the formula is different. Yeah.
I'm still like 81,000.
Yeah.
At year 6.
Yeah, so the formula is different. If we look at the formula from like declining balance, you were using the previous year's book value. Here the formula is saying don't use the previous year's book value, it's the cost basis. The overall cost basis.
Purchase value.
Purchase price, yeah.
Purchase price. Okay, thank you.
Yeah. I'm glad we resolved that, and just in the nick of time because it's 5:15.
I thought I was
So
listening.
no, you asked a good question, and I think other people were headed down that same path, but we got it figured out. Okay, last thing, let me show you some info about this canoe race tomorrow, because I think it would be fun if you're interested to come. The canoe race is being held at Beach Fork Lake. If you haven't been there before, I mean, it's perfect weather these days. That's maybe too wide. It's perfect weather. Beach Fork Marina is about, here is showing the drive is maybe 25, 30 minutes from campus. And you can put the address into your GPS, Beach Fork Lake Marina. And tomorrow I think they're going to be doing the canoe race. If we look at the schedule, the check-in is at 8, but I think they're actually going to start doing the race maybe more like 10 o'clock is what I've heard. So it's just going to be hanging out at a lake with a bunch of engineers, you know, what could be more pleasant than that? And then on a Saturday, over at the football stadium, they're doing the steel bridge competition. So if you're interested to watch the steel bridge competition, I think if you go over to the football stadium about 9, they'll probably actually be doing the measurements and the competition. So everyone's invited for that. I just wanted to point it out. Last pass around the announcements, remember, is that the project is due a week from today. So if you have questions on the project, just let me know and I'll be happy to help you on that.